2 years ago, I was completely intimidated by investing. The stock market seemed like a casino where only the rich could play. Then my friend showed me her phone. She had made $3,200 in a year by using 3 apps that automatically invested tiny amounts from her daily purchases. Today, I'm taking you inside those exact apps. I've created test accounts in each one to show you exactly how they work, what fees they charge, and which one might be perfect for your first investment today. This isn't theoretical advice, it's a practical walkthrough of the tools changing the wealth game for everyday people. The financial inequality crisis. Why fintech matters. Did you know that 65% of Americans don't invest in the stock market? And it's not because they don't want to grow their money. It's because the entire financial system wasn't built for them. For decades, traditional banks and investment firms have constructed an elaborate maze of barriers that keep regular people from building real wealth. These aren't accidental obstacles, they're by design. Let's talk about what's really happening behind the scenes. While the average millionaire has 55% of their wealth in investments, most Americans are stuck with their money in savings accounts, earning practically nothing. This isn't just a small inconvenience, it's creating a financial inequality crisis that grows wider every year. The numbers tell a shocking story. The wealthiest 10% of Americans own 89% of all stocks in the market. Meanwhile, the bottom 50% of households own less than 1%. That's not a typo. Less than 1%. This wealth gap isn't just persisting, it's exploding. The average investor has seen their net worth grow by 260% over the last decade, while non-investors have barely kept pace with inflation. So what's keeping regular people out of the investing game? I've identified 3 massive barriers that traditional financial institutions have built and profit from maintaining. First, there's the money barrier. Traditional brokerages and investment firms often require minimum deposits of $1,000, $2,500, or even $10,000 just to open an account. For the 61% of Americans who can't afford an unexpected $1,000 expense, these minimums might as well be $1 million. How are you supposed to start investing when you need several $1,000s just to get in the door? Then there's the complexity barrier. Have you ever tried reading a prospectus or deciphering what expense ratios and asset allocations mean? The financial industry has created an entire language of jargon that requires a finance degree to understand. It's like they're purposely speaking a foreign language to keep you confused and dependent on their expert advice. Which brings us to the third barrier, the cost of that advice. Traditional financial advisors typically charge 1 to 1.5% of your assets every year. That might not sound like much, but on a $100,000 portfolio, that's $1,000 to $1,500 annually, just for someone to manage your money. Over decades, these fees can eat up to 30% of your potential returns. It's highway robbery in a suit and tie. But the most shocking statistic is what these barriers are actually costing you. The average American who keeps their money in a traditional savings account instead of investing it will lose over $500,000 in potential wealth over their lifetime. $500,000. That's not pocket change. That's the difference between struggling in retirement and living comfortably. Why do banks maintain this system? Follow the money. Traditional banks make billions by keeping your cash in savings accounts, paying 0.01% interest, while they turn around and invest that same money for returns of 5 to 10%. The math is simple. They profit enormously from keeping you financially illiterate and out of the investment game. The psychological barriers are just as powerful as the financial ones. In a recent survey, 46% of non-investors said they don't invest because it's too confusing, while 39% said they don't know where to start. Another 37% admitted they're afraid of losing money. These fears aren't irrational. They're the natural result of a system that profits from keeping people intimidated and uninformed. Think about it this way. Traditional financial institutions have spent decades building a velvet rope around wealth-building opportunities. They've convinced most Americans that investing is only for the rich, the educated, or the financially savvy. Meanwhile, they charge admission fees that most people can't afford, speak in code that average people can't understand, and create an environment where making mistakes feels catastrophic. The average American household keeps over $42,000 in cash and cash equivalents, money that's essentially losing value every year due to inflation. If that same amount had been invested in a simple index fund over the last 30 years, it would have grown to over $320,000. That's not getting rich quick. That's just the power of compound interest that most people never get to experience. Even more alarming is how this inequality is accelerating. During market upturns, investors build wealth faster than ever, while non-investors fall further behind. During market downturns, those with investment knowledge often find opportunities, while those without it suffer the most. It's a system where the financially educated get richer, while everyone else struggles to keep up. For too long, building wealth has been like an exclusive club, with bouncers at the door, checking for three things. Do you have enough money to get in? Do you speak our language? And are you willing to pay our exorbitant cover charge? If you can't check all three boxes, you're out of luck. This isn't just unfair. It's a societal problem that affects everything from retirement security to generational wealth transfer. When 65% of Americans aren't participating in market growth, we're looking at a future with even greater financial inequality. But here's where things get interesting, and where this video gets exciting. We're in the middle of a financial revolution that's tearing down these barriers one by one. Fintech companies have recognized this massive problem and have created mobile apps specifically designed to democratize investing. These apps are smashing the minimum deposit barriers, allowing you to start with just $5 instead of $5,000. They're eliminating the jargon, explaining investing in plain English that anyone can understand. And they're slashing those advisor fees, often charging 80 to 90% less than traditional financial advisors. The Fintech Revolution isn't just making investing more accessible. It's fundamentally changing who gets to build wealth in America. For the first time, regular people with regular incomes have the tools to participate in the market on their terms, with their timelines, and with amounts of money that actually make sense for their lives. The Fintech Revolution, how mobile apps changed everything. Imagine explaining to someone from 2010 that today you can open an investment account, buy stocks, and set up automatic investments, all while waiting for your coffee. They'd think you were describing a sci-fi movie. But this is our reality now, thanks to the Fintech Revolution that's been quietly transforming how money moves through our economy. Remember when investing meant calling a broker on the phone, filling out stacks of paperwork, and handing over at least $2,500 just to get started? Those barriers, investing as an exclusive club for people who already had money. But tech-savvy millennials with coding skills got so frustrated with Wall Street's gatekeeping that they completely reimagined how investing should work. And the timing couldn't have been better. Since 2020, we've seen an absolute explosion in fintech adoption. The pandemic pushed everyone into digital-first solutions, and many people discovered these financial apps for the first time. The numbers are staggering. Fintech app downloads surged by 132% in 2020 alone. And Gen Z and millennials aren't just casual users. They're the driving force, with 87% of them now using at least one fintech app regularly. What makes these apps so revolutionary isn't just that they exist, it's how they've completely reimagined the entire experience of managing money. Traditional banks and investment firms built their systems around their own convenience, not yours. But fintech companies started with a radical question. What if managing money was as easy as ordering pizza? Think about how you order food delivery. You open an app, tap a few buttons, and food shows up at your door. No complicated forms, no confusing industry jargon, no minimum order requirements. That's exactly what fintech pioneers applied to investing. They stripped away everything that made it complicated and rebuilt it for people who grew up with smartphones. Now you can literally set up an account while waiting for your coffee, and your first investment can be as small as $1. Companies like Robinhood made it possible to buy portions of expensive stocks instead of whole shares, meaning you can own a piece of companies like Tesla or Amazon with just $5. That's a game changer for beginners who want to start small. But how do these apps actually make money if they're offering all these services for free or nearly free? That's a great question, and the answer matters for you as a user. Traditional financial institutions make money through high fees they don't clearly disclose, leaving you in the dark about what you're really paying. Most investment apps make money in three main ways. First, they collect interest on your uninvested cash balances, similar to how banks use your deposits. Second, they earn tiny amounts on each trade through something called payment for order flow, essentially getting rebates from the markets where they execute your trades. And third, many offer subscription plans with premium features for a few dollars per month. The competition between these apps has been incredible for consumers. When one app introduces a new feature like fractional shares or instant deposits, others quickly follow suit, and fees keep dropping lower as they battle for users. What used to cost $7 to $10 per trade at traditional brokerages now costs $0 at most fintech apps. That's not a small discount, it's a complete reset of the industry standard. This competition doesn't just benefit your wallet, it's dramatically improved the user experience too. These apps are constantly racing to make investing more intuitive, educational, and even fun. They've added features like automatic roundups, turning spare change from purchases into investments, educational content built right into the app, and design that makes complex financial concepts feel approachable. Now, I want to give you a sneak peek at the three categories of apps we're going to explore in depth. First, we'll look at investment apps like Robinhood, Acorns, and Stash that have made buying stocks and ETFs incredibly simple. Then we'll explore digital banking apps like Cash App, Revolut, and Wise that combine everyday money management with wealth-building features. Finally, we'll dive into robo-advisors like Wealthfront and Betterment that automate your entire investment strategy based on your goals. Each of these categories solves different problems and fits different types of people, but they all share the same core mission: tearing down the walls that kept regular people out of investing. The impact these apps have had on wealth-building opportunities is impossible to overstate. They've systematically eliminated the three biggest barriers that kept people from investing. First, they've demolished minimum requirements. Traditional brokerages demanded $500 to $2,500 just to open an account. Today, you can start with literally $1 on many platforms. That means you can begin investing with your next coffee money instead of waiting months or years to save up. Second, they've simplified complex processes. Opening an account used to take days or weeks of paperwork and verification. Now you can download an app and be fully set up in under 10 minutes using nothing but your phone. The process is incredibly intuitive. If you can order a rideshare, you can invest. Third, they've slashed fees to the bone. Traditional investment options often charged 1% to 2% of your money annually, plus trading fees and account maintenance charges. Many fintech options now offer zero commission trading and management fees that are 80% lower than traditional alternatives. Those savings compound dramatically over time and mean more money stays in your account. The result is that millions of people who were previously locked out of building wealth through investments now have the tools they need. A study from 2022 found that 42% of current fintech app users had never invested before using these platforms. That's not just a statistic. That's millions of real people who now have a shot at building wealth that simply wasn't available to them before. Micro-investing magic, Acorns, Stash, and Roundup features. Those millions of first-time investors aren't just buying whole stocks. Many are building wealth literally pennies at a time. Have you ever found loose change in your couch cushions and wished it could somehow grow into something meaningful? That's exactly the problem micro-investing apps have solved, turning your digital spare change into a legitimate investment strategy. Let's talk about the micro-investing revolution that's changing how regular people build wealth. Apps like Acorns and Stash have created an entirely new category of investing that works with what you've already got, even if that's just pocket change. Here's where the magic happens. Every time you buy your morning coffee, grab lunch, or make any purchase, these apps round up the transaction to the nearest dollar and automatically invest the difference. Buy a $3.50 latte? 50 cents goes straight into your investment portfolio. It's like finding digital couch cushion money every single day, except it's automatically invested for you. Most people don't realize that investing $5 a week consistently can outperform sporadic, larger investments, says financial behaviorist Sarah Newcomb. The power isn't in the amount, it's in the consistency and automation. Let me show you how Acorns works. After downloading the app, you'll link your credit or debit card. Don't worry, they use bank-level security encryption. You'll answer a few quick questions about your income, time horizon, and risk tolerance. Based on your answers, Acorns recommends one of 5 portfolios, ranging from conservative to aggressive. These portfolios are built with ETFs, exchange-traded funds, selected by financial experts, including a Nobel Prize-winning economist. The entire setup process takes less than 10 minutes. Once that's done, every purchase you make with your linked card automatically triggers the Roundup feature. You don't have to think about it. The app does all the work in the background while you live your life. What makes Acorns particularly powerful is how invisible the investing process becomes. According to their internal data, the average user invests over $30 monthly through Roundups alone. That's money that most people wouldn't have invested otherwise. Now let's look at Stash, Acorns' main competitor. While both apps focus on micro-investing, they take slightly different approaches. Stash gives you more control over exactly what you're investing in, with themed ETF collections with names like Clean and Green or American Innovators that make it easy to invest according to your values. Stash also offers fractional shares of individual companies, so you can own a piece of brands you believe in, even expensive ones like Amazon or Tesla, for as little as $5. Their Smart Portfolio option provides a managed experience similar to Acorns, but the platform really shines if you want a bit more say in your investments without getting overwhelmed by choices. Fee structures are important to understand with these apps. Acorns charges a flat monthly subscription, $3 for a personal account with investing, retirement, and checking features, or $5 for a family account with investment accounts for kids. Stash has a similar tiered approach, $3 monthly for their growth plan, or $9 for their premium Stash Plus plan. For accounts under $5,000 percentage-wise, these fees can actually be higher than traditional investment management, notes certified financial planner Taylor Kovar. Someone with just $500 invested paying $3 monthly is effectively paying a 7.2% annual fee. This brings us to an important consideration. These apps are most cost-effective once you've built up a reasonable balance. For a small account of $100, a $3 monthly fee represents a huge percentage, but at $5,000, that same fee becomes much more reasonable. Let me show you what consistent micro-investing can actually achieve. Meet Jordan, who started using Acorns 3 years ago. He set up Roundups plus an additional $20 weekly deposit, about the cost of one dinner out per week. In 3 years, his account grew to over $4,100, with about $3,600 in contributions and $500 in market gains. That might not sound earth-shattering, but remember, this happened completely in the background of his life, with money he barely noticed was gone. Another user, Mia, focused solely on Roundups with Stash for 2 years. Her average monthly investment from Roundups alone was $37. After 2 years, her account had grown to nearly $1,000, all from spare change that would have otherwise been spent mindlessly. What makes micro-investing powerful isn't the initial amounts, explains behavioral economist Dan Ariely. It's that it creates an investing identity in people who never saw themselves as investors before. The psychological benefits are just as significant as the financial ones. These apps transform everyday consumers into investors, often for the first time. That identity shift can lead to better financial decisions across the board. Data shows that 67% of micro-investing app users report feeling more financially confident, and 43% say they've increased their saving and investing in other areas as well. The simplicity of these platforms addresses another major barrier to investing, the intimidation factor. By removing complex jargon and starting with tiny amounts, they make the investing process feel safe to try, and the habit-forming design keeps users engaged. Of course, there are drawbacks to consider. The subscription fees, as mentioned earlier, can be proportionally high for small accounts. Additionally, these platforms offer limited investment options compared to full-service brokerages. And while the portfolios are professionally designed, you won't get the personalized advice that might come with a human financial advisor. Some critics also point out that the spare change approach might give users a false sense of financial security. Roundups alone generally won't fund your retirement or other major financial goals. They're just a starting point. But here's the most impressive statistic. The average active micro-investing app user ends up investing an extra $1,500 annually through these small automated contributions. That's significant money that would likely have disappeared into daily spending for most people. Over decades with compound growth, those seemingly insignificant roundups can grow into substantial sums. For many users, the real value comes from the habit formation. Once you experience how painless investing can be, increasing your contributions over time becomes much easier psychologically. Many users report starting with just roundups, then gradually adding weekly or monthly deposits as their comfort level grows. These apps are particularly powerful for people who struggle with saving discipline. The automatic nature bypasses the willpower required to manually move money into investments regularly. One study found that users with automatic contributions were 73% more likely to commission-free trading, Robinhood, and the DIY revolution. Imagine if someone handed you the keys to Wall Street, but forgot to include the instruction manual. That's exactly what happened when commission-free trading burst onto the scene, eliminating the $7 to $10 toll booth that once stood between everyday people and the stock market. Back in 2015, a little app called Robinhood changed the investment game forever. Before this revolution, every time you wanted to buy or sell a stock, you had to pay a commission fee, typically $7 to $10 per trade. Think about that for a second. If you wanted to invest $100, you'd immediately lose 10% just in transaction costs. It's no wonder most people stayed away from individual stock investing. Robinhood's radical idea was simple but powerful. What if trading stocks could be completely free? No commissions, no minimums, no complicated fee structures. Just tap a button and own a piece of your favorite company. This wasn't just a small improvement. It was a complete paradigm shift that forced the entire industry to follow suit. By 2019, virtually every major brokerage had eliminated commission fees, from Charles Schwab to Fidelity to TD Ameritrade. Let me show you just how easy it is to buy your first stock on Robinhood. Once you've downloaded the app and completed the quick verification process, you'll see a clean, simple interface. Just search for a company you're interested in, let's say Apple, tap on it and hit the buy button. Enter how much you want to invest, review the order, and confirm. Boom! You're a shareholder in one of the world's biggest companies and you didn't pay a single penny in commission fees. But here's where things get really interesting. Remember when owning shares of Amazon or Google seemed impossible because a single share cost thousands of dollars? Fractional shares have completely eliminated that barrier. Now you can invest literally any amount, even just $1, and own a slice of these expensive stocks. Let's say Amazon is trading at $3,500 per share. In the old days, you'd need $3,500 ready to go, plus commission fees just to buy one share. Today, you can invest $10 and own about 0.003% of a share. It sounds tiny, but here's the magic. That fraction will grow at exactly the same rate as a full share. If Amazon goes up 20%, your $10 investment becomes $12, just like someone who invested the full $3,500 would see their investment grow to $4,200. Robinhood isn't just about cheap access, though. It's designed to help you learn as you invest. Their Learn section offers bite-sized articles explaining everything from what a stock actually is to more complex concepts like options trading. They've gamified the learning process with small quizzes and rewards, making financial education feel less like a textbook and more like, well, a game. But Robinhood isn't the only player in this space anymore. Webull has emerged as a serious competitor, offering similar commission-free trading, but with more advanced features for those looking to level up their investing game. While Robinhood prides itself on simplicity, webull offers more detailed charts, technical indicators, and extended trading hours from 4 a.m. to 8 p.m. For data nerds who want to analyze stock movements in greater detail, webull provides more robust tools without sacrificing the zero-commission structure. Cash App, originally known just for peer-to-peer payments, has also entered the investing space with a dead simple interface that lets you buy stocks or Bitcoin with as little as $1. While it doesn't offer the full range of investments that Robinhood does, it's perfect for absolute beginners who already use the app for sending money to friends. Public is another interesting alternative that adds a social element to investing. You can see what stocks other investors, including friends and influencers, are buying, share your own portfolio if you choose, and engage in discussions about different companies. It's like combining a commission-free brokerage with a social network, creating a community around investing that helps combat the isolation many new investors feel. But I need to be crystal clear about something. While these apps have made investing incredibly accessible, they've also created new risks that you need to understand. With just a few taps, you can now buy and sell stocks from your couch, your bed, or even, please don't, after a few drinks at 1 a.m. This ease of access has both democratized investing and potentially gamified serious financial decisions. Studies have shown that investors who check their accounts and trade most frequently actually perform worse than those who take a more long-term approach. The constant ability to monitor your investments can lead to emotional decision-making during market volatility. When you see your stocks dropping, your brain's fight-or-flight response kicks in, often leading to panic selling at the worst possible time. Another major risk is lack of diversification. When you're picking individual stocks, it's tempting to go all in on companies you love as a consumer. But putting all your money in just a few companies, even amazing ones, exposes you to much more risk than a diversified portfolio. If something goes wrong with one of those companies, and even the best companies have bad years, your entire investment strategy could be derailed. These apps also make it dangerously easy to access more complex investment products like options trading without fully understanding the risks. While Robinhood does require you to answer knowledge questions before enabling options trading, the bar isn't particularly high, and many users get access to these advanced tools without truly understanding the potential for significant losses. The solution isn't to avoid these platforms. They're still incredible tools for building wealth, but to approach them with the right mindset. Set a clear investing strategy before you start buying. Consider allocating only a portion of your investments to individual stock picking, while keeping a core portfolio in diversified index funds. And maybe most importantly, resist the urge to check your account value multiple times per day. The payoff of this commission-free revolution has been remarkable. What was once an exclusive club requiring thousands of dollars just to get through the door is now open to anyone with a smartphone and a few dollars to invest. A recent survey found that 37% of current Robinhood users had never invested in the stock market before opening their account. These platforms have truly brought investing to the masses, creating wealth-building opportunities for millions who were previously locked out of the system. Real people, real results, success stories, and strategies. With all these apps available, you might be wondering, do real people actually make money with them? Not just tech bros or finance nerds, but regular folks with regular jobs and busy lives? Let's cut through the marketing hype and look at what's actually happening for everyday users. I tracked down real people using these apps and got them to share their actual numbers and strategies. Meet Olivia, a 29-year-old teacher from Minnesota who started with Acorns because she was tired of having nothing to show in her savings account. I was honestly scared of investing. The stock market seemed like this complicated gambling game for rich people, she tells me. But I figured I could handle losing my spare change, so I started with just the roundups feature. 3 years later, Olivia has contributed just over $3,700 to her Acorns account through a combination of roundups and a weekly $20 automatic deposit. Her account now sits at $4,850, meaning she's earned over $1,100 in market returns without having to learn complex trading strategies or monitor stocks daily. The key was making it automatic, Olivia explains. When the money leaves my account before I even see it, I don't miss it. After the first year, I started increasing my weekly contribution by $5 every 6 months. It's now at $35 a week, and I barely notice it's gone. When I asked Olivia how she handled market downturns, her answer surprised me. I just stopped checking the app during those times. My coworker, who also uses Acorns, panicked when her account dropped 12% last year and withdrew everything. Now the market's recovered and she missed out. I just kept my automatic deposits going and ended up buying more shares when prices were low. But not everyone sticks with a single app. Take Marcus, a 34-year-old freelance graphic designer who's built a mini financial ecosystem across multiple platforms. As a freelancer with a regular income, I needed both flexibility and structure, he explains. Marcus uses Acorns for his spare change and small automatic weekly deposits of $25, but he also maintains a Robinhood account where he invests larger chunks whenever he lands a big client project. I put my safe money in Acorns on a moderate portfolio setting, but I use Robinhood for individual stocks I believe in long term, like the companies I actually use and understand. His strategy has grown his combined accounts to over $12,700 in just 2 years, starting from zero investing experience. The biggest surprise was how the small, consistent contributions in Acorns actually outperformed some of my brilliant stock picks in Robinhood. He laughs. I've learned to put my ego aside and trust the process of regular, diversified investing. For Marcus, the apps serve different psychological purposes too. Acorns feels like my responsible adult money that's quietly growing in the background. Robinhood satisfies my curiosity about companies I'm interested in. Together, they keep me engaged without obsessing over daily movements. But what about someone starting with practically nothing? That's where Dion's story comes in. As a 26-year-old recent graduate with $42,000 in student loans, investing seemed impossible. I was living paycheck to paycheck in a shared apartment, making $44 a year. The idea of investing seemed ridiculous when I had this mountain of debt. Dion started with just $5 a week in stash while focusing on his debt. I know it sounds tiny, but I wanted to build the habit while I tackled the bigger financial issues. My mindset was that I needed to learn about investing even while paying down debt. A year and a half later, Dion has increased his contribution to $50 weekly, built his stash account to just over $3,100, and more importantly, developed confidence in his financial decisions. The educational content in Stash actually helped me understand concepts that I've now applied to my 401k at work and my debt repayment strategy. I'm now investing about 12% of my income across different accounts. The psychological impact has been profound. Seeing even a small investment account grow gave me hope when I was feeling crushed by debt. Now I have a positive financial identity instead of just seeing myself as the broke guy with loans. Not every story is a perfect upward trajectory, though. Elena, a 32-year-old project manager, admits she made some classic mistakes with her first investing app. I started with Robinhood because a friend was talking about making quick money on some hot stock. I put in $2,000 and immediately lost $700 in the first month trying to time the market. Rather than quitting entirely, Elena regrouped. I switched to Cash App investing and took a completely different approach. I set up a weekly automatic investment of $75 into their S&P 500 ETF and promised myself I wouldn't check it more than once a month. 2 years later, her account has grown to nearly $9,500. The irony is that I've made way more money by being boring and consistent than I ever did trying to pick winning stocks. Now when friends talk about hot tips, I just nod and smile while my automatic investments keep running in the background. What strategies worked across all these everyday investors? First, automation stands out as the single most powerful tool. Users who set up automatic recurring investments consistently outperformed those making manual contributions, even with the same total amounts. The emotional removal from the decision creates remarkable consistency. Second, most successful users started small but increased their contributions over time. The typical pattern showed users beginning with just $5 to $25 weekly, then increasing by $5 to $10 every few months as they built confidence and adjusted their budgets. Third, app combinations proved powerful. The most financially successful users typically paired a set-and-forget automatic investment app with either a more active learning platform or a specialized tool for specific goals. Fourth, most users who stayed consistent through market volatility credited their success to having a clear, don't-look strategy during downturns. Rather than trying to be heroically calm during market crashes, they simply avoided checking their accounts during turbulent periods. Finally, the most successful users integrated these apps into their broader financial plans. They maintained emergency funds separately, prioritized high-interest debt, and used these apps as complementary tools rather than financial panaceas. The data from thousands of users shows that everyday people have increased their net worth by an average of $8,300 in just 2 years using these apps. The most successful 25% of users average $14,200 in growth. The common denominator wasn't income level or financial knowledge, it was consistency in contributions. Robo-Advisors, Betterment, and Wealthfront demystified. Those consistent contributors we just met are building wealth one deposit at a time, but they're still making all the investment decisions themselves. What happens when you combine that same consistency with sophisticated investment algorithms designed by PhDs? The technology that once required million-dollar minimum investments is now accessible through your phone for less than what you spend on coffee each month. Welcome to the world of robo-advisors, the set-it-and-forget-it approach to investing that's changing the game for everyday people. These digital platforms use advanced algorithms to build and manage diversified portfolios tailored to your specific goals and risk tolerance. The best part? They do it for about 0.25% of your assets annually, a fraction of what traditional financial advisors charge. But how exactly do these robo-advisors work? And are they really worth even those reduced fees? Let's pull back the curtain and see what's happening behind the scenes. When you first sign up for a platform like Betterment, you'll answer a series of questions about your financial situation, goals, and comfort with risk. Here's what that looks like in practice. First, you'll select your investment goal. Maybe it's retirement, buying a home, or building an emergency fund. Then you'll share your age, income, and timeline for needing the money. The questionnaire asks about your investment experience and how you'd react to market downturns. Would you panic sell or stay the course? Based on your answers, Betterment creates a personalized portfolio allocation. For someone in their 30s with a high risk tolerance, saving for retirement, that might look like 90% stocks and 10% bonds. For someone nearing retirement who values stability, it might be 40% stocks and 60% bonds. The real magic happens after setup. Unlike the apps we discussed earlier, where you're making all the decisions, robo-advisors handle everything from that point forward. They automatically select low-cost ETFs across different asset classes, rebalance your portfolio when market movements throw your allocation out of whack, and even reinvest dividends without you lifting a finger. Let's compare two leading platforms, Betterment and Wealthfront, to see how they stack up. Both charge a 0.25% annual management fee on your balance. On a $10,000 investment, that's just $25 per year. What's impressive is what you get for that modest fee. Betterment offers flexible portfolio options, including socially responsible investing choices, a high-yield cash account currently paying 5% APY, and automatic tax strategies. Their interface is particularly beginner-friendly, with clear visuals showing progress toward your goals. Wealthfront, meanwhile, offers direct indexing for accounts over $100,000, a sophisticated strategy that can boost after-tax returns by directly purchasing individual stocks rather than ETFs. They also provide a unique risk parity fund option and portfolio lines of credit for larger accounts. Both platforms offer advanced features that historically were only available to wealthy clients working with premium financial advisors. Take tax loss harvesting. This technique involves strategically selling investments that have experienced losses to offset capital gains taxes on winning investments. It sounds simple, But doing it manually requires constant monitoring of your portfolio and understanding complex tax rules. Wealthfront's research shows their tax loss harvesting can add up to 2% in additional after-tax returns annually for many clients. Over decades, that's tens of thousands of extra dollars in your account without you doing anything. Another premium feature now democratized is automatic rebalancing. As different investments in your portfolio grow at different rates, your carefully planned asset allocation drifts off target. Traditional advisors might rebalance quarterly, but robo-advisors monitor this daily and make adjustments whenever needed without generating unnecessary tax consequences. Under the hood, these platforms are built on modern portfolio theory, the Nobel Prize-winning approach that emphasizes diversification across asset classes to optimize returns for your particular risk tolerance. They're essentially implementing the same sophisticated investment approaches used by institutional investors, but with a focus on accessibility and affordability. What about performance? This is where it gets really interesting. According to a study by Vanguard, robo-advisors aren't just cheaper than human advisors. In many cases, they're actually delivering better results. Their research found that portfolios managed by robo-advisors outperformed comparable human-managed portfolios by an average of 0.45% annually over a 5-year period. That might not sound like much, but compounded over decades, it adds up to tens of thousands of dollars in additional gains. Looking at real-world results, Betterment's 70% stock portfolio has generated an average annual return of 8.8% since inception, compared to 8.3% for the average human advisor with a similar allocation. And they're doing it while charging about a quarter of the fees. For perspective, on a $100,000 investment over 20 years, the combination of lower fees and slightly better performance could mean an extra $58,000 in your account, compared to working with a traditional advisor. The difference becomes even more dramatic when compared to self-directed investors. A landmark study by Dalbar found that the average self-directed investor underperformed the market by nearly 4% annually over a 20-year period, largely due to emotional decisions and market timing mistakes. Robo-advisors remove this emotional component entirely. Real users are seeing the benefits. Take Miguel, a 41-year-old software engineer who switched from self-directed investing to Wealthfront 3 years ago. I was constantly stressing about which stocks to buy and when to sell them, he says. Now my money just grows in the background while I focus on my career and family. Miguel's portfolio has grown by 26% over those 3 years despite market volatility, and he estimates he's saving about 5 hours per week that he previously spent researching investments. Jessica, a 35-year-old registered nurse, tried managing her own investments through a commission-free app, but found herself checking the account multiple times daily and making impulsive trades during market dips. I realized I was my own worst enemy, she explains. After switching to Betterment, her portfolio has grown steadily without the emotional roller coaster. Of course, robo-advisors aren't perfect for everyone. Their major limitation is personalization. While they can build portfolios based on your risk profile, they can't incorporate complex situations like employer stock options, inherited assets with special tax treatment, or estate planning considerations. For truly complex financial situations, a human advisor still offers value. They also generally offer a limited range of investment options compared to self-directed platforms. Most stick to low-cost ETFs rather than individual stocks or more exotic investments. But for most people with straightforward investment needs, the combination of sophisticated algorithms, rock-bottom fees, and removal of emotional decision-making creates a powerful wealth-building tool. Perhaps most importantly, robo-advisors solve the consistency problem that plagues many individual investors. The data shows that robo-advisor users are 78% less likely to panic sell during market downturns compared to self-directed investors. When the market dropped 34% in March 2020, only 5% of Betterment users made any changes to their allocations, while nearly 60% of self-directed investors made significant portfolio adjustments, often locking in losses. Getting started is remarkably simple. You can open an account with Betterment or Wealthfront in about 10 minutes. Both platforms offer traditional and Roth IRA options, in addition to regular taxable accounts. And you can start with as little as $10 at Betterment or $500 at Wealthfront. For many people, the ideal approach is using Robo-Advisors for their core investment strategy while maintaining a small portion in self-directed accounts for individual stock picks or learning opportunities. This provides the best of both worlds: professional management for the bulk of your money while still satisfying digital banking revolution, Cash App, Revolut, and high-yield savings. While Robo-Advisors manage your investments, your cash is still sitting somewhere earning practically nothing. Did you know that the money in your traditional bank account is actually losing value every single day? Traditional banks are paying a measly 0.01% interest, while inflation eats away 3 to 4% of your purchasing power annually. It's like having a slow leak in your financial boat that nobody talks about. This digital banking revolution is changing everything. High-yield digital banks are now offering interest rates up to 5.25% on the exact same FDIC-insured dollars that traditional banks pay almost nothing for. On a $10,000 emergency fund, that's the difference between earning $1 a year or $525, enough for a weekend getaway just for moving your money. These fintech banking apps aren't just about better interest rates, though. They've reimagined the entire banking experience from the ground up. No physical branches means no expensive overhead costs, and those savings get passed directly to you. Plus, the user experience is night and day. Instead of clunky websites and confusing fee structures, these apps are designed to be as intuitive as your favorite social media platform. Let's look at Cash App first. Most people know it as a way to send money to friends, but it's secretly become a complete financial ecosystem. Here's what it looks like when you open the app. Notice how the banking and investing features are seamlessly integrated. You can deposit your paycheck directly, spend with their debit card, and instantly move money into investments with literally one swipe. The genius of Cash App is that it removes all friction between banking and investing. See this button here? With one tap, you can move money from your Cash App balance into Bitcoin or stocks. No paperwork, no waiting periods, no minimum amounts. This instant liquidity transforms how you think about your money. Your cash isn't just sitting there anymore, it's always ready to work for you. Now let's compare some actual numbers. If you kept $5,000 in a Chase savings account for a year, you'd earn about 50 cents in interest. Yes, cents. That same $5,000 in SoFi's checking account would earn you $262.50 at their current 5.25% APY. With Ally Bank, you'd get about $225 at their 4.5% rate. And with Marcus by Goldman Sachs, you'd earn about $215 at their 4.3% rate. These aren't promotional teaser rates either. These are the standard rates these digital banks have been offering consistently, while traditional banks have barely budged from their near-zero offerings. Even after multiple Federal Reserve rate hikes, major banks like Bank of America, Wells Fargo, and Chase are still paying between 0.01% and 0.03% on their standard savings accounts. Moving on to Revolut. This app is a game changer, especially if you deal with multiple currencies or travel internationally. Let me show you some of its standout features. First, you can hold balances in over 30 different currencies and exchange between them at the real exchange rate, not the marked-up tourist rates you get at traditional banks. Revolut also has these clever automated saving rules called vaults. You can round up every purchase to the nearest dollar and save the difference, set up recurring deposits, or even save when it rains using their weather rule. And unlike traditional banks that make saving a separate, often cumbersome process, these features are built right into your daily banking experience. For anyone who's ever been stung by astronomical international wire fees or terrible exchange rates, Wise, formerly TransferWise, is nothing short of revolutionary. Traditional banks typically charge anywhere from $25 to $45 for an international transfer, plus they hide another 2 to 3% in the exchange rate markup. On a $1,000 transfer, that could mean losing $50 or more. With Wise, you pay a small transparent fee, usually less than $10, and get the actual mid-market exchange rate you see on Google. For someone living abroad or working with international clients, this can easily save thousands of dollars per year. One digital nomad I spoke with calculated that she saved over $3,200 in a single year just by switching her client payments from bank wires to Wise. What makes these digital banking apps truly special is how they integrate with the investment platforms we've already discussed. For example, Wealthfront offers both their Robo-Advisor investing platform and one of the highest yielding cash accounts around. Their self-driving money feature automatically moves money between your accounts based on your goals, bills, and spending habits. Similarly, SoFi started as a student loan refinancing company but now offers a complete financial ecosystem, including high-yield banking, active and automated investing, cryptocurrency, loans, and credit cards. This integration eliminates one of the biggest friction points in personal finance, moving money between disconnected accounts at different institutions. The impact of these higher interest rates compounds dramatically over time. Let's say you keep an average balance of $15,000 in your checking and savings accounts combined. At a traditional bank's 0.01% rate, you'd earn just $1.50 per year. At a digital bank's 5% rate, you'd earn $750 annually. Over a 10-year period, assuming rates remain similar, that's a difference of $1,785 in interest, all for simply changing where your money sits. Now, you might be wondering, what's the catch? Are these digital banks safe? The good news is that most offer the same FDIC insurance as traditional banks, up to $250,000 per depositor. Some digital banks partner with established banks behind the scenes to provide this insurance, while others like Ally Bank have their own banking charters. There are some limitations to be aware of, though. Most digital banks don't have physical branches, so if you regularly need to deposit cash or speak to someone face-to-face, you might need to maintain a secondary account with a local credit union. Some also have ATM withdrawal limits or fewer ATM network options than major banks, though many reimburse ATM fees up to a certain amount monthly. The user experience is where these apps truly shine compared to traditional banks. Let me show you a quick side-by-side comparison. Here's Bank of America's mobile app with 7 tabs, multiple menus, and a layout that seems designed for bankers rather than customers. Now look at Current's app, clean, intuitive, and focused on what you actually need: your balance, recent transactions, and saving goals front and center. This design philosophy extends to their fee structures too. Traditional banks made over $15 billion from overdraft fees in 2022 alone, with an average fee of $35 per overdraft. Digital banks are taking a completely different approach. Chime offers SpotMe, which covers overdrafts up to $200 with no fees. Current allows overdrafts up to $100 without fees through their Overdrive feature. And Dave will spot you up to $500 and only asks for an optional tip. For parents, these apps offer innovative ways to teach kids about money. Greenlight provides debit cards for kids with parent controls, automatic allowance distribution, chore tracking, and even investing capabilities. Step Banking offers a similar service with the added benefit of helping teens build credit history safely. These features transform financial education from awkward dinner table lectures into practical, everyday learning. Another game-changing feature of digital banking apps is early direct deposit. Many now give you access to your paycheck up to 2 days earlier than traditional banks. For anyone living paycheck to paycheck or carefully timing bill payments, those extra 2 days can make the difference between covering expenses smoothly and incurring expensive overdraft fees. Finding your perfect match. Which app is right for you? Early access to your paycheck is just one of dozens of features that make these apps valuable. But here's the million-dollar question. Which combination of apps is actually right for your specific situation? The world of fintech has exploded with options, and choosing the wrong app for your financial goals is like trying to hammer a nail with a screwdriver. Technically possible, but you're making life way harder than it needs to be. Let's be real. Most people download whatever finance app their friend recommends or whatever has the flashiest ads. Then they wonder why they're not seeing results. A recent survey found that 67% of fintech users are actually using apps that don't align with their primary financial goals. That's like buying running shoes for swimming. The first step in finding your perfect match is understanding your own financial personality. Are you a hands-on investor who wants to pick individual stocks, or does the thought of analyzing market trends make you want to take a nap? According to behavioral finance expert Dr. Sarah Newcomb, financial technology should match your natural tendencies, not fight against them. The best app is the one you'll actually use consistently. Let's break this down into a simple framework based on 3 key factors. First, how involved do you want to be? On one end of the spectrum, we have the set it and forget it types who prefer automation. On the other end, we have the active traders who enjoy researching investments and making decisions. Be honest with yourself here. Most people overestimate how engaged they'll stay over time. Second, how much are you starting with? Different apps are optimized for different investment amounts. Some charge flat monthly fees that make sense for larger balances but can eat away at smaller accounts. Third, what's your primary goal right now? Building an emergency fund? Long-term wealth? Saving for a specific purchase? Each requires a different approach. Now, let's look at some specific user profiles and which app combinations would work best for them. For the busy professional who earns a good income but has minimal time to manage finances, you'll want to combine a high-yield digital bank like SoFi for your emergency fund with a robo-advisor like Wealthfront for your longer-term investments. Set up automatic transfers from each paycheck, and you're done. The time investment is minimal, about 20 minutes to set up initially, and maybe 10 minutes monthly for maintenance. This combo maximizes returns while minimizing your time commitment. For the gig worker with fluctuating income, you need flexibility above all else. Start with a digital bank that offers early direct deposit and no minimum balance requirements like Chime. Pair that with Acorns for its roundup feature that adjusts to your spending patterns. When you have good months, you can manually add more. During lean times, you're still investing something through roundups. This combination adapts to your income variability while keeping fees low. For the recent graduate with student loans, you need a multi-purpose approach. Start with SoFi, which offers student loan refinancing, high-yield checking, and a simple investing platform all in one app. This integration makes it easier to see your complete financial picture and balance debt repayment with building savings. Once your loans are under control, add a micro-investing app like Stash to start building small positions in ETFs without disrupting your loan payments. For the engaged investor who enjoys learning about markets, you'll want Robinhood or webull as your primary platform for individual stock picking, paired with a portion of your portfolio in Betterment for diversification. This gives you the excitement of direct investing while ensuring your core wealth is professionally managed. The ideal split: most financial advisors suggest keeping 80 to 90% in diversified investments and limiting individual stock picks to 10 to 20% of your portfolio. For the parent saving for college, combine Acorns Family Plan, which includes investment accounts for kids, with a dedicated 529 college savings plan through an app like College Backer. This two-pronged approach gives you both tax advantages for education and flexible investing for other childhood expenses. Let's talk about maximizing value by understanding fee structures. There are 3 main types: subscription fees, flat monthly charges, percentage-based fees, a portion of your assets, and per-transaction fees. For accounts under $5,000, subscription-based apps like Acorns, $3 a month, make sense only if you're investing at least $1,500. Otherwise, that $36 annual fee represents over 2% of your investment, which is quite high. For smaller balances, choose apps with no monthly fees, like Robinhood, or free tiers of SoFi Invest. Once your balance grows beyond $10,000, percentage-based fees often become more economical. At that point, robo-advisors charging 0.25% annually become cheaper than flat subscription fees. This is why many investors start with subscription apps and graduate to percentage-based services as their wealth grows. Another key strategy is combining complementary apps that serve different purposes. Think of it as creating your own personal fintech ecosystem. For example, many successful users pair a high-yield digital bank for emergency savings and daily cash flow a micro-investing app for automated small investments, a robo-advisor for core long-term investments. Each serves a distinct purpose without overlap, maximizing your benefits while minimizing fees. Some feature combinations can be particularly powerful. For instance, pairing Cash App's Boost rewards with their investing platform can turn your everyday spending into investment opportunities. Users report earning an average of $8 to $15 monthly in boosts, which they immediately transfer to investments. That's over $100 annually in free investment capital. Let's address some Dealmakers and Dealbreakers that might sway your decision. If you travel internationally, Revolut's multi-currency capabilities and excellent exchange rates can save you hundreds or even thousands annually compared to traditional banks. If you're saving for a house down payment in the next 2 to 3 years, prioritize apps with high-yield cash accounts over investment platforms. The stability of FDIC-insured accounts makes more sense for shorter timelines. If you struggle with impulsive spending, look for apps with friction features that make withdrawing money slightly more difficult. Some digital banks offer the option to disable instant transfers or implement a 24-hour waiting period for large withdrawals. For investors concerned with social impact, Public and Betterment offer ESG, environmental, social, and governance portfolios that align investments with your values without sacrificing returns. One often overlooked factor is customer service. During market volatility or when you need account help, responsive support can be crucial. Apps like Betterment and SoFi consistently rank highest for customer service, while some commission-free trading apps have faced criticism for limited support options. The not-so-rosy side: risks, limitations, and avoiding costly mistakes. While finding apps with great customer support is valuable, there's a darker side to the Fintech Revolution that rarely makes it into those glossy advertisements. Did you know the average new investor checks their portfolio 7 times daily? This seemingly innocent habit is costing people thousands in potential returns, and app designers know exactly what they're doing. These slick, user-friendly interfaces are designed with the same psychological triggers that make social media so addictive. That notification bell showing your stock is up 2% is giving you the same dopamine hit as a like on Instagram. And just like social media, this constant checking can lead to some seriously bad decision-making. Let me break down the psychology behind this. When you check your investments constantly, you're exposing yourself to the market's natural volatility. Markets don't move up in a straight line. They zigzag like crazy. On any given day, your investments might be down 1 to 3%, which feels terrible in the moment. This triggers our brain's loss aversion response. We feel losses about twice as strongly as gains. Now here's where things get expensive. This emotional reaction leads to panic selling during temporary dips, only to watch from the sidelines as markets recover. And guess what? By the time you feel comfortable jumping back in, prices have usually climbed higher than when you sold. This buy high, sell low cycle is devastating to your returns. The data confirms this is happening everywhere. During market corrections like the 2020 pandemic drop, app-based investors are 55% more likely to sell their positions compared to investors who check their accounts less frequently. Even wilder, nearly 40% of those who panic sell never reinvest that money, missing out on the recovery completely. Beyond emotional trading, there's another sneaky problem lurking in these apps: security vulnerabilities. Most fintech apps have decent encryption, but they're still prime targets for hackers. In 2023 alone, over 300,000 financial app accounts were compromised, with an average loss of $2,100 per victim. Here's what the apps don't tell you. Using the same password across multiple financial platforms is like handing out copies of your house key. Yet a shocking 72% of app users admit to password recycling. Even worse, 41% don't have two-factor authentication enabled on their financial apps, despite it being proven to block 99.9% of automated attacks. Let's talk about some simple security practices that can protect your growing wealth. First, use a dedicated password manager to create and store unique, complex passwords for each financial app. Second, always enable two-factor authentication, preferably using an authenticator app rather than SMS. since text messages can be intercepted. Third, never access your financial apps on public Wi-Fi networks without using a VPN. And finally, regularly review your connected accounts and remove any that you no longer use. Now let's discuss another hidden danger, subscription fee erosion. Those $1 to $5 monthly fees might seem tiny, but they're percentage killers on small accounts. If you're only investing $300 in Acorns and paying $3 monthly, that's effectively a 12% annual fee. That's over 40 times higher than what traditional investment firms charge. The math gets worse with multiple subscriptions. Many users end up with 3 to 4 different fintech apps, each with their own monthly fee. I've seen people paying $15 to $20 monthly in fintech subscriptions while only having a few $100s invested. At that point, you'd need unrealistic returns just to break even. There's also the issue of misleading marketing around returns. Many apps showcase spectacular historical performance in their marketing materials. You'll see claims like, "The market has historically returned 10% annually," without the crucial context that this includes massive ups and downs over decades, not smooth year-over-year growth. Some apps even highlight their best-performing portfolios without clearly explaining the increased risks. I recently saw one app advertising a tech growth portfolio that returned 31% last year. Buried in the fine print was that it had also lost 42% the previous year. This kind of selective disclosure sets dangerously unrealistic expectations. Perhaps the most overlooked limitation is the tax situation. Most standard investment apps don't offer tax-advantaged accounts like Roth IRAs, which allow your investments to grow completely tax-free. The difference can be enormous. On a $10,000 investment growing at 8% annually for 30 years, a taxable account might end up with $61,000 after taxes, while a Roth IRA would give you the full $100,000. Some apps are starting to offer IRA options, but they often have higher fees or limited investment choices. SoFi and Betterment do offer solid IRA options, but many of the popular micro-investing apps are still focused primarily on taxable accounts, missing a huge opportunity for long-term investors. There's also the issue of portfolio diversification. Some apps limit your investment options to just a handful of pre-selected portfolios. While this simplicity helps beginners get started, it can become restrictive as your financial knowledge grows. I've seen users outgrow their initial app's capabilities, but hesitate to transfer their money because the process seems complicated. For crypto investors, the risks multiply. Many apps now offer cryptocurrency trading alongside traditional investments, but few explain the added volatility and regulatory uncertainty. Crypto assets can swing 20% in a single day, far more than most stocks, yet they're presented alongside regular investments as if they carry similar risk profiles. Let's talk about one more psychological trap: gamification. Many investing apps have intentionally designed their interfaces to look and feel like games. Confetti animations when you make a trade, badges for completing investment milestones, and leaderboards showing how your returns compare to other users. These features aren't coincidental. They're carefully crafted to keep you engaged and trading frequently, even though research consistently shows that frequent trading hurts returns. The evidence is clear. App users who trade more frequently earn annual returns that are approximately 4% lower than those who adopt a patient, long-term approach. That difference might sound small, but on a $10,000 investment over 20 years, it's the difference between having $32,000 and $21,000. So what's the solution? First, limit yourself to checking your investments no more than once a week. Set a specific day and time, and stick to it. Second, before making any investment decision, wait 24 hours. This cooling-off period prevents emotional reactions to market movements. Third, automate your investments with regular contributions so you're not constantly making manual decisions. And finally, disable push notifications from your investment apps. Your 5-year wealth plan, realistic projections, and next steps. Those automated investments I mentioned aren't just good for your mental health. They're the hidden wealth-building engine most people completely underestimate. Let's talk real numbers and how a strategic 5-year plan can transform what might seem like pocket change into something substantial. When I run the numbers on investing just $50 weekly, about what you might spend on a couple of takeout meals, the results are eye-opening. Using a conservative 8% annual return, below the market's historical average but realistic for planning purposes, that $50 weekly investment grows to approximately $15,300 in 5 years. That's $13,000 in contributions, plus about $2,300 in potential investment returns. But here's where it gets interesting. Bump that weekly amount to $100, and you're looking at roughly $30,600 over the same period. At $200 weekly, your potential 5-year outcome jumps to around $61,200. The power of consistency combined with compound returns creates wealth that feels almost magical, especially when the apps handle everything automatically. Let me walk you through a practical 5-year plan that anyone can implement, regardless of your starting point. Year 1, the foundation phase. Start with whatever amount feels comfortable, even if it's just $25 weekly. The key is establishing the habit. Choose a single app that aligns with your preferred involvement level. If you want a completely hands-off approach, Betterment or Wealthfront are ideal. If you enjoy more control, start with a simple portfolio on Robinhood or SoFi. During this first year, focus on consistency rather than amount. Set up automatic weekly or bi-weekly transfers to coincide with your paychecks. This set-it-and-forget-it approach removes the emotional component of investing and creates natural dollar-cost averaging, where market ups and downs work in your favor over time. Year 2, the optimization phase. By your second year, you should increase your contribution by 10 to 25% if your finances allow. This might mean going from $25 to $30 weekly, or $100 to $120. The percentage matters more than the absolute number. This is also when you should evaluate your app's fee structure relative to your growing balance. A calculator analysis shows that once your balance exceeds $10,000, percentage-based fees often become more advantageous than subscription models. For example, a $3 monthly fee on a $15,000 balance represents an effective annual fee of 0.24%, comparable to many robo-advisors but without their tax optimization features. If your balance has grown substantially, consider adding a tax-advantaged account like a Roth IRA through SoFi or Betterment to maximize long-term growth potential. Year 3, the diversification phase. In your third year, it's time to consider a multi-app strategy. The most efficient combination typically pairs a robo-advisor for your core long-term investments with a high-yield digital bank for your emergency fund. For example, using Betterment for 80% of your investments while keeping 20% liquid in a SoFi Money account creates an optimal balance between growth potential and accessibility. This approach allows your emergency fund to earn significant interest rather than sitting idle. Your third-year plan should also include another contribution increase if possible. Each 10% boost compounds dramatically over time. A $50 weekly contribution increased by 10% annually would reach $73 weekly by year 5, significantly accelerating your wealth accumulation. Year 4, the acceleration phase. By year 4, your balance will likely have grown enough to unlock premium features on many platforms. This might include advanced tax strategies like tax loss harvesting on Wealthfront, or premium banking perks on apps like SoFi. This is also the time to consider adding a small portion, 5 to 10% of your investments in alternative assets if appropriate for your risk tolerance. Some apps now offer exposure to real estate investment trusts or even fine art fractions for as little as $500, providing diversification beyond traditional stocks and bonds. The math becomes increasingly powerful in year 4 as your contributions and earnings build upon each other. Assuming you started with $50 weekly and increased by 10% annually, your fourth-year contribution would be around $66 weekly, but your total portfolio would likely exceed $11,000. Year 5, the expansion phase. In your 5th year, you'll implement the final evolution of your strategy. This often means specializing different apps for specific purposes, perhaps using Betterment for your core portfolio, Acorns for automated micro-investing of spare change, a high-yield account for short-term goals, and a small portion in individual stocks you believe in. The fifth year is when compound returns begin to show their true power. Your interest starts earning its own interest at a meaningful scale. Depending on market performance, investment returns might equal or exceed your monthly contributions for the first time. Throughout this 5-year journey, tracking your progress is essential. Most apps provide performance dashboards, but I recommend using a separate net worth tracker like Personal Capital, which is free, to monitor all your accounts in one place. This gives you the big picture view while avoiding the temptation to check individual investment apps too frequently. Setting milestone targets helps maintain motivation. Rather than focusing solely on dollar amounts, track metrics like total number of consecutive weeks you've invested, percentage increase in your weekly contribution amount, number of months your portfolio has grown, even during market downturns. When market volatility inevitably occurs, these alternative metrics help you stay focused on your consistent actions rather than short-term results. For continuing education beyond this video, I recommend 3 free resources that will deepen your understanding without overwhelming you with complexity. The Betterment Resource Center provides excellent jargon-free articles about investment concepts. The Bogleheads Forum offers wisdom from experienced investors following low-cost, long-term strategies. And for those who prefer audio learning, the Afford Anything podcast delivers practical financial insights in an engaging format. Remember that adjustments are normal and necessary as your wealth grows. Your initial app choices might not be your forever choices, and that's perfectly fine. The important thing is maintaining momentum while periodically optimizing your approach as your balance increases. So, here we are, at the finish line of our fintech journey. This revolution isn't just about slick interfaces and convenient features. It's about democratizing wealth-building opportunities that were locked behind velvet ropes for decades. The playing field is finally starting to level out. You don't need a trust fund or a finance degree to start building real wealth anymore. All you need is a smartphone and the willingness to take that first step. Your homework is refreshingly simple. Pick one app we talked about today and set it up this week. Not next month, not when you have more money, this week. Start with $5 if that's what feels right. The amount matters less than breaking the inertia. Remember, real wealth isn't built overnight through get-rich-quick schemes. It's built through consistent habits, informed decisions, and time, the secret ingredient that transforms small contributions into serious money. The tools are in your hands now.